So, imagine two traders. Let's just call them Trader A and Trader B.
Okay.
Both of them sit down at their desks on, January 1st, and they have exactly $10,000 in their accounts.
Right.
And over the next 4 trades, both of them end up making a net profit of exactly 10%. So their final balances are identical.
Right.
Exactly the same.
Right. So if you were just, I don't know, looking at a year-end spreadsheet, you would assume they had the exact same level of success. But what that spreadsheet hides is that Trader B almost lost their house.
Oh, absolutely. The path they took to arrive at that identical final number was completely different, and that difference is everything in quantitative finance.
Yeah.
Trader A, they made a steady, predictable, 2.5% on 4 consecutive trades.
Nice and easy.
Right, nice and easy. But Trader B, on the other hand, suffered a 50% catastrophic loss on trade number 1.
Which means their 10 grand was instantly cut to 5 grand.
Yeah.
Just a brutal psychological blow right out of the gate. It's devastating. And from there, Trader B makes a 50% return, which, brings the account to $7,500.
Okay, so they're clawing back.
Exactly. But then another 20% loss drops them back down to $6,000.
Oh, man.
And finally, on trade 4, they hit a massive, desperate 65% win, bringing them, miraculously back to that final 10% profit.
That is an absolute financial nightmare.
It really is.
Because if you lose half your money on day 1, you don't need a 50% gain to get back to where you started. You need a 100% gain just to break even.
Exactly. The math works against you.
And yet, if a quantitative analyst looks purely at the historical backtest of Trader B's system, they just see a line that eventually ends up, up and to the right.
Yeah, and that illusion of the perfect past is exactly what we are dismantling today.
Yes.
We're exploring the concept of sequence risk and the computational stress tests that professional quants use to ensure they don't blow up their accounts.
And we have a really dense stack of sources for this deep dive. I mean, we are pulling from advanced quantitative finance manuals, hardcore software documentation from algorithmic platforms like Strategy Quant X and AMI Broker.
Yeah, some heavy-hitting stuff.
Really heavy. Plus these deep dive technical analyses from expert quant blogs like Sophie Daddy Quant and Switch Markets.
Right.
So our mission today is to basically understand why relying on historical market data is this massive psychological trap.
It's a huge trap.
And how traders use complex probability to strip away the illusion of a pristine backtest.
Because the foundational issue we are dealing with here is what quantitative analysts refer to as the epistemological crisis of trading.
That's a mouthful.
It is, but it's crucial. Basically, when a trader builds an algorithm, runs it over, say, 10 years of historical data, and sees this beautiful, profitable equity curve, they naturally assume they've discovered some permanent truth about the market.
Right. They think they've cracked the code.
Exactly.
Mm-hmm.
But mathematically, that historical backtest, no matter how rigorous it is just one realization of a stochastic or random process.
Okay.
It is literally a sample size of 1.
Well, I want to push back on that idea just a bit because I think a lot of people struggle with this concept.
Sure.
If an algorithm traded, let's say, the S&P 500 from 2010 to 2020 and generated a 200% return, that isn't a theoretical model. Those trades actually happened.
Yeah.
The market actually moved that way. So why doesn't that concrete reality serve as proof that the system works?
Because the market environment that generated those specific returns will never exist in that exact configuration again.
Ah.
I mean, think about it. The geopolitical events, the institutional order flow, the macroeconomic data releases, they all aligned in one very specific chronological sequence.
Right, right.
So to assume your future returns will look like your past returns is to basically assume the universe will repeat that exact sequence of events.
It's like looking at one specific timeline in a multiverse and assuming it is the only way things could have played out.
That framing captures the danger perfectly. Because in the markets, the sequence of wins and losses is largely dictated by variance.
Yeah.
Going back to our initial example, if Trader B's massive 65% win had happened on day 1, and that brutal 50% loss had happened last, the compound math changes the final account balance entirely.
Oh, completely.
So relying on a sample size of one historical timeline leaves you completely blind to the reality that your real-world future sequence of returns could easily cluster all your historical losses into one devastating month.
Wow. So if the timeline we actually live through is just one random path out of millions, how do we possibly evaluate an algorithm's true risk? I mean, we can't travel to alternate universes to see how the strategy performed under different luck.
Well, we don't need to observe alternate universes because we
Yeah.
can computationally generate them.
Okay, let's unpack this.
This brings us to the core of modern risk management, which is the Monte Carlo simulation.
Right, and the name always makes it sound like a casino game, but the origins are rooted in something far more intense than blackjack.
Very much so. The methodology was formalized back in the 1940s by Stanislaw Ulam.
Okay.
He was a mathematician working at the Los Alamos National Laboratory.
So the Manhattan Project?
Exactly. He was dealing with problems of neutron diffusion and nuclear chain reactions, and the standard deterministic mathematics required to calculate the exact probability of neutron collisions were simply too vast and complex to solve.
Even for the best minds of the era.
Right.
So how do you solve a math problem that is technically unsolvable?
Well, Ulam realized that while he couldn't calculate the exact mathematical outcome, he could simulate the process thousands of times using random numbers and observe the aggregate results.
Oh, I see.
And legend has it, he came up with the idea while recovering from an illness and playing solitaire.
Wait, really? Solitaire?
Yeah. He wondered what the statistical probability was of winning a game. But instead of trying to calculate the nearly infinite combinatorial math of a deck of cards, he realized he could just, play 100 random games, count the wins, and arrive at a highly accurate estimate.
That's brilliant.
And he named the technique Monte Carlo, acknowledging its inherent connection to the mathematics of gambling and probability.
So that transition from nuclear physics and solitaire directly applies to a trader's log of buys and sells.
Exactly.
We aren't trying to predict the exact path of a single neutron or a single stock price. We are trying to understand the aggregate behavior of a system under randomness.
Yes. In algorithmic trading, the system we are testing is your backtest. Instead of running a massively complex simulation over decades of historical tick data, which is just computationally exhausting, we look at the finished output.
Right, the trade log.
We extract your trade log. If your backtest generated, say, 500 trades over 10 years, we take that lift of realized profits and losses, and we mathematically manipulate them. The strategy quant documentation outlines a few distinct ways to do this, starting with what they call the exact method.
Also known as permutation without replacement.
Right.
So if we use a card analogy, this means we take your exact history of 500 trades, your personal deck of cards, and we simply shuffle the deck. We deal them out in a completely new order.
Exactly. Every single historical trade is drawn exactly once. Because the raw ingredients haven't changed, the total net profit at the end of the simulation remains exactly the same as your original backtest.
The overall distribution of your wins and losses is identical.
Yeah.
But if the final profit is identical, what is the value of shuffling the deck?
It explicitly isolates the sequence risk we discussed with Trader B.
Oh, okay.
By shuffling the order of the trades thousands of times, you can observe how deep your portfolio drawdowns would have been if your losses had happened to cluster together differently.
So you might find that in your original historical backtest, your losses were neatly spaced out, allowing your account to recover.
Right, you got lucky.
But in simulation number 412, 7 of your worst historical losses hit back-to-back, triggering a margin call.
Exactly. It shows you the hidden risks in the exact same trades.
That makes sense for analyzing the arrangement of the past, but the sources push heavily toward a second method that completely breaks the boundaries of the original backtest.
Yeah, they call it resampling or bootstrapping.
Right. Here's where it gets really interesting, because resampling is sampling with replacement.
Yes.
This is where the simulation stops just rearranging the past and starts modeling the true uncertainty of the future.
This is the real deal.
So instead of shuffling a fixed deck of cards, it's more like drawing a number out of a hat, recording the profit or loss, and then throwing that number back into the hat before you draw again.
That replacement mechanism changes everything. In a resampling simulation, if your backtest had a pool of 500 historical trades, one specific massive loss might randomly be selected 4 times in a single simulated timeline.
Oh, wow.
Conversely, your biggest historical win might never be drawn at all.
Which means the total net profit of the simulation is no longer tethered to the original backtest.
Not at all.
Every single timeline we generate is going to end up with a wildly different final bank account balance.
And the scale of that variance is just staggering. I mean, the quantitative analysis provided in our check source material breaks down the combinatorics.
Yeah.
With resampling, The number of possible unique equity curves is calculated as n to the power of n, where n is your number of trades.
So if a trader has a highly selective algorithm that only made 100 trades over 5 years, the Monte Carlo simulation generates 100 to the power of 100 possible timelines.
Think about how massive that is.
Mm.
That figure vastly exceeds the estimated number of atoms in the observable universe.
That is insane.
It is. The probability of any single resampling simulation randomly perfectly recreating your original historical backtest is functionally zero.
Right.
And that vast chaotic variance is precisely why institutional quants rely on it, because real-world markets are messy. Your future win rate will absolutely drift from your historical average. Resampling mathematically models what happens to your capital when your algorithm simply hits a cold streak, or when the market environment temporarily stops offering the setups you rely on.
But running that n to the power of n calculation means we are generating billions of possible futures. From a purely practical standpoint, a human being cannot sit at a desk and read 10,000 different simulated spreadsheets.
Definitely not.
How do professionals actually visualize this data without drowning in the noise?
Well, they aggregate those thousands of simulated equity curves into a single visual framework known as the cone of uncertainty.
Oh, I've seen these. If you picture this on a screen, it starts at a single solid point on the left side, which represents today, right? Your current starting capital.
Yep.
And as time moves forward to the right, the simulated timelines fan out.
Right. They spread out.
Some paths shoot up toward massive exponential profits, some crash aggressively downward, but a thick, dense cluster of lines forms a solid cone in the middle.
Exactly. And what's fascinating here is how that cone forces traders to abandon the concept of a single average expectation. And instead, they have to think in terms of percentiles.
Right.
Running right through the densest middle section of that cone is the P50 line.
The median curve.
The median curve. Half of the simulated futures finished above that line and half finished below it.
But professional risk managers do not build their capital allocation models based on the median expectation, do they?
No, never. They look at the darkness at the bottom edge of the cone. They focus on the tail risk, specifically the 95th percentile or the P95.
Let's break down how percentiles work in this context, because usually, being in the 95th percentile is a good thing, like scoring in the top 5% on an exam.
Right, but here we are measuring drawdowns and losses.
Right.
In risk management, we are always measuring the severity of the downside tail. If we run 10,000 resampling simulations, we generate 10,000 different maximum drawdowns. We take those 10,000 numbers and arrange them in order, from the mildest diff to the most catastrophic total loss. The value sitting at the 9,500th position is the P95 drawdown.
Meaning 95% of all our simulated futures experienced a drawdown that was less severe than this specific number.
Exactly.
Only 5% of the timelines were worse.
Right. Therefore, if your P95 maximum drawdown is 30%, you can state with a 95% statistical confidence level that your real-world losses will not exceed 30%.
And this metric is basically the absolute bedrock of institutional risk management.
It is the industrial standard benchmark.
But what happens when that bottom edge of the cone doesn't just dip 30%? What happens when those lines plummet straight into the floor? The source material refers to this as calculating the probability of ruin.
Yeah, and historically, assessing ruin was a very rigid theoretical exercise.
That's so.
Well, traders relied on formulas like the Balsara model, which is an elegant but highly constrained mathematical equation. It estimates the probability of blowing up an account based on fixed assumptions, like assuming your win rate will always be exactly 50% and your payoff ratio will always be exactly 2-to-1.
But markets aren't fixed, and algorithm win rates fluctuate wildly depending on the volatility regime.
Exactly why modern quants prefer empirical probability over theoretical models.
Right. They want the real messy data.
Yeah. Monte Carlo calculates ruin directly from the messy, realistic distribution of your actual strategy. In the documentation for the MT5 equity projection tool, they define ruin not as hitting absolute zero, but as hitting an uncle point.
An uncle point?
Yeah, the moment your equity falls below 20% of your starting capital, you say, uncle, you give up.
Because if a trader loses 80% of their portfolio, the math required to recover is so punitive that they are functionally dead in the water anyway.
Absolutely. The psychological toll alone would force them to turn off the algorithm.
So the simulation simply acts as an auditor. It counts. Out of the 10,000 paths generated, how many crossed that lethal 20% threshold?
Exactly. If 3,300 paths breach the limit, your empirical probability of ruin is 33%.
Wow.
And a strategy with a 1 in 3 chance of catastrophic failure is toxic, regardless of how attractive the P50 median returns might look on a marketing brochure.
So if a retail trader is building an automated system in a software suite like Strategy Quant, it sounds like looking at the cone could still be highly subjective.
It can be.
Is there a hard mathematical benchmark they can use to determine if a strategy is actually robust enough to trade with live capital?
The documentation highlights a stringent industry-standard benchmark known as the 5200 filtering rule.
The 5200 rule.
Yeah, it acts as an automated gatekeeper.
Okay, how does it work?
To pass the test, you run your resampling Monte Carlo, and you isolate that P95 confidence boundary. First, at that P95 level, your simulated net profit must remain greater than 50% of your original historical backtest profit.
So even if you experience terrible luck in the live markets and your performance falls into the bottom 5% of possible futures, the algorithm still has to generate at least half the profit you initially expected.
Exactly. It proves the strategy isn't entirely dependent on catching, 2 or 3 massive lucky trades to stay afloat.
Right. And the second part,
The second half of the rule addresses survival. Your P95 max drawdown must be less than 200% of your original backtest drawdown.
let's ground that in real numbers. If my original historical backtest showed a very comfortable 10% maximum drawdown, but the Monte Carlo simulation reveals that the P95 drawdown is actually 22%.
Okay.
Does that mean the algorithm is broken and I have to throw it away?
Well, no, it doesn't mean the alpha is broken. It means your expectations and your capital allocation are broken.
Ah, I see.
You fail the original test parameters, but the strategy might still be viable if you adjust. You must capitalize your live trading account based on the expectation of a 22% drawdown, not a 10% drawdown.
Because if I size my positions using leverage that assumes the worst case scenario is 10%, and the real world market delivers the statistically highly probable 22% hit, my account will face a margin call.
Bingo. The 5200 rule is essentially forcing the trader to normalize their expectations to statistical reality rather than historical luck.
That normalization process is crucial for survival.
Absolutely crucial.
Well, it sounds like a foolproof mathematical shield. So if my strategy passes this resampling test, if it survives the n to the power of n test, passes the 5200 rule, I'm bulletproof. I can just flip the switch to live trading and walk away confidently.
And that assumption is exactly how sophisticated quantitative funds end up in catastrophic liquidation.
Wait, really?
Yeah, you are assuming the Monte Carlo engine itself is flawless.
It's not.
But Monte Carlo will absolutely lie to you, and it will underestimate your risk if you feed it the wrong statistical assumptions.
Where's the blind spot? This raises an important question.
The entire mathematical foundation of basic resampling relies on something called the IID assumption.
AID.
It stands for independent and identically distributed. In plain English, it assumes that the outcome of trade number 12 has absolutely zero impact on the outcome of trade number 13.
Like flipping a coin. If I flip heads, the coin doesn't remember that, and it doesn't change the 50-50 odds of the next flip being tails. The events are totally isolated.
Right. But in financial markets, particularly for certain types of algorithmic strategies, that assumption of independence is fatally flawed.
Why?
Let's look at a classic trend-following strategy. Trend-following algorithms inherently rely on a phenomenon known as volatility clustering.
Meaning the market moves in regimes.
Exactly.
A trend follower will suffer a long, agonizing string of small, paper-cut losses while the market chops around sideways. But then, a central bank makes a surprise announcement. A massive directional trend emerges, and the algorithm captures a cluster of huge sequential wins.
The trades are linked by the market environment.
Okay.
There is serial correlation. Institutions take days or weeks to unwind massive positions, which creates directional momentum. The environment causes the cluster. Now, think about the mechanics of simple randomized resampling. If you apply that method to a trend-following trade log, what happens to those clusters?
Oh, I see it. The simulation would take those tightly clustered massive wins that occurred during the trending regime, and it would artificially scatter them evenly throughout the entire simulated timeline.
Yes, it spreads them out.
It would mix them randomly among all the small, choppy losses. It's like taking a beautifully composed piece of music, shuffling all the individual notes randomly, and then wondering why the melody is gone.
That is a perfect analogy.
You are still playing all the same notes, but by destroying the sequence, you destroy the entire structure of the song.
And that destruction of structure is the fatal flaw. By artificially dispersing the clustered wins among the losses, the Monte Carlo simulation dramatically and dangerously smooths out the equity curve.
It makes it look better than it is.
It erases the painful reality of those long, drawn-out losing streaks that actually define trend-following systems.
Which means the simulation will spit out a P95 maximum drawdown that is significantly smaller and milder than what the trader will actually experience in the live market.
Exactly. The very computational test designed to protect the trader from risk is now systematically underestimating that risk, providing a totally false sense of mathematical security.
Wow. So if a simple resampling destroys the melody of the algorithm, how do quants fix the simulation? We clearly can't just abandon stress testing for trend-following systems.
No, we definitely can't. To fix the blind spot, quants use an evolution of the methodology called stationary block bootstrapping.
Block bootstrapping. How does chunking the data solve the autocorrelation problem?
Instead of isolating and shuffling individual, single trades, the simulation algorithm groups the trades together into continuous chronological blocks.
Okay, so it keeps them together.
For example, the software might group all the trades that occurred within a specific rolling 30-day or 60-day window.
Going back to the music analogy, instead of shuffling individual notes, the algorithm picks up entire chords or full measures of the song and shuffles those intact blocks.
Yes. By keeping those 30-day chunks intact, the simulation preserves the local market memory. The regime dependency remains unbroken.
So if a cluster of wins occurred together during a high volatility event, they stay clustered in the simulation.
Right.
And if a brutal 6-month drawdown of small losses occurred, that losing streak is tested as a single devastating block.
Exactly. So you maintain the structural reality of the market environment while still mathematically shuffling the sequence of those environments to see how bad things could get.
That seems like a much more rigorous reflection of reality. Are there other structural blind spots that Monte Carlo misses?
Oh, definitely. Another massive vulnerability occurs with overlapping trades.
Overlap.
Yeah, many automated strategies don't just open a single position, wait for it to close, and then look for the next setup. A sophisticated algorithm might hold a basket of positions simultaneously.
Like a grid trading system.
Right. Or a multi-currency portfolio holding long positions in the euro, the pound, and the yen all at once.
Okay, I see where this is going. If a sudden macroeconomic shock hits the currency markets, all three of those open positions are going to plummet in value at the exact same second. Your portfolio takes a massive synchronized hit.
But if you take a raw log of those trades and feed it into a basic Monte Carlo simulator, the engine doesn't understand time.
It doesn't.
No, it processes the trades sequentially, one after the other.
Oh, I see the masking effect. The simulator looks at the log and thinks you took a small hit on the euro, then your account recovered. Then you took a small hit on the pound, and your account recovered. It completely fails to register the simultaneous catastrophic portfolio-level drawdown.
That masking effect is exactly how multi-strategy funds blow up in real life.
Mm.
They assume their risk is diversified, but the simulation hid the correlation. To solve this, advanced testing platforms like EmiBroker utilize a different approach entirely.
How do they bypass the trade log?
Instead of randomizing the list of completed trades, they randomize the bar-by-bar portfolio equity changes.
Okay.
The simulator looks at how the total aggregate value of your entire portfolio changed minute by minute or day by day, and it bootstraps those daily equity changes. Alternatively, they use a joint block bootstrap.
Which does what?
It ensures that the cross-asset correlations across the entire portfolio are preserved during the stress test.
Okay, so we've covered a tremendous amount of highly abstract computational theory. I mean, we understand the vast combinatorics of resampling, the institutional reliance on the P95 cone of uncertainty, and the necessity of block bootstrapping to preserve market memory.
That's a lot.
It is a lot. But how does a professional quantitative desk actually integrate all of this into their daily workflow? How do they turn abstract math into concrete trading decisions tomorrow morning?
They remove the human element entirely and build these tests into an automated pipeline, often referred to as a robustness funnel.
A robustness funnel.
Yeah. Software suites like Strategy QuantX are explicitly designed to handle this workflow. In modern algorithmic design, machine learning engines might generate thousands of potential trading strategies overnight. A human analyst cannot manually review the Monte Carlo results for thousands of algorithms.
That would be impossible. So the software acts as a gauntlet.
Exactly. Yeah.
If a strategy fails a specific threshold at any point, the automated kill switch triggers and the algorithm is instantly deleted.
Yep, it's gone.
Walk us through how that funnel actually operates from start to finish.
Sure. So it begins in the generation phase. The machine builds a strategy and runs a basic, incredibly fast backtest on historical data. This initial pass might take, 0.2 seconds per strategy.
Super fast.
If the algorithm shows basic profitability, it graduates to a higher precision retest.
Which means checking the mechanics, verifying that the backtest engine wasn't hallucinating favorable fill prices or ignoring liquidity constraints.
Right. And once the mechanics are validated, it enters the Monte Carlo trades manipulation phase. This is where the engine runs the 10,000 simulated timelines to check the 5200 filtering rule we discussed earlier.
Okay, so it calculates the empirical probability of ruin.
Exactly. If the strategy's P95 drawdown is acceptable, it survives. But then it faces the final and most computationally brutal test in the funnel, which is the Monte Carlo retest with parameter jitter and degraded execution.
Parameter jitter. That sounds like the system is actively trying to break the algorithm's logic.
It absolutely is. Up until this point, we've only been shuffling the results of the trades. In the final phase, the system actually runs hundreds of entirely new backtests, but in each simulated run, it slightly alters the foundational rules of the strategy itself.
Okay, give me an example.
Well, if the core algorithm relies on a 50-day moving average, the Monte Carlo engine will test it using a 48-day average and then a 52-day average.
Testing to see if the strategy is robust or if it only works perfectly because it was curve-fitted to that exact 50-day parameter.
Exactly. Simultaneously, the engine injects random slippage, simulating terrible, delayed fill prices, and randomly widens the bid-ask spread to mimic volatile, illiquid market conditions.
That has to require immense processing power compared to the initial sweep.
The computational cost is immense. While the initial basic backtest took a fraction of a second, a Monte Carlo retest running hundreds of variations of parameter jitter, slippage, and spread widening can take 20 seconds or more per single strategy.
Wow, per strategy.
Yeah, multiply that by thousands of generated strategies, and you are dedicating serious server time to the task.
I can imagine.
But it is an absolutely vital expenditure of processing power to filter out fragile, over-optimized systems before real institutional money is put on the line.
Okay, let's follow that live money. If a quantitative manager has a portfolio of 3 different algorithmic strategies that all miraculously survive the robustness funnel, how do they combine them? I imagine they can't just throw them all into the same master account, allocate equal capital, and hope for the best.
No, definitely not. If we connect this to the bigger picture, the application of capital is where Monte Carlo transforms from a defensive testing tool into an active strategic allocation tool.
Okay.
This process is known as portfolio risk normalization.
Walk us through a concrete scenario of how a manager normalizes risk across different assets.
Imagine a fund manager has strategy A, which trades the euro currency markets, and strategy B, which trades gold futures.
Okay, gold and the euro.
Gold is inherently more volatile than the euro. So if you simply allocate $1 million to strategy A and $1 million to strategy B will mathematically dominate the portfolio's returns and its drawdowns.
Because a normal day of volatility in gold might dwarf a wild day in the euro.
Exactly. To balance the risk, the manager runs the Monte Carlo simulation on strategy A in isolation and identifies its P95 maximum drawdown.
Okay.
Let's say strategy A projects a P95 drawdown of 15%. Then they run the simulation on strategy B and find that its P95 drawdown is 40%.
So on a worst-case tail risk basis, the gold strategy is nearly 3 times as dangerous. How do they synchronize them?
The firm will have a hard internal risk mandate, let's say a strict portfolio-wide drawdown limit of 20%.
Right.
The manager mathematically adjusts the position sizing or the leverage of each individual strategy upward or downward until their simulated P95 drawdowns perfectly match that 20% limit.
The mechanics of that are fascinating. They would actually scale strategy A, the euro strategy, upward, increasing its leverage until its tail risk hits 20%.
Yes.
And they would throttle strategy B, the gold strategy, downward, reducing its position sizing until its simulated worst-case scenario also projects exactly 20%.
Precisely. By adjusting the leverage based on the Monte Carlo output, the manager normalizes the algorithms.
So neither strategy can unexpectedly dominate and destroy the portfolio just because it encountered a historically unprecedented sequence of volatility.
Right. Both algorithms are mathematically leashed to the exact same worst-case boundary. It creates a genuinely balanced portfolio where risk is allocated based on simulated tail risk severity, not just historical average returns.
That is so smart. But even with risk perfectly normalized across the portfolio, there is still one lingering vulnerability we haven't addressed.
What's that?
What if the underlying logic of the strategy itself is entirely hollow? The Sophie Daddy Quant blog highlighted a stress test that blew me away. They call it the truth serum test, and it involves something called surrogate data. How does that expose a fake strategy?
Surrogate data testing, also known as phase shuffling, is the ultimate reality check.
Okay.
It determines whether your algorithm has actually discovered a genuine exploitable edge in the market or if it is just a highly sophisticated statistical coincidence.
So we're no longer shuffling the trade log and we aren't jittering the parameters. We are attacking the historical market data itself.
Exactly. You take the actual historical price chart of an asset,
Hmm.
let's say the S&P 500, and you run it through a mathematical transformation. You randomize the phase of the data. This creates a completely synthetic, artificial price chart. It is pure statistical noise, but crucially, it maintains the exact same basic volatility profile and frequency distribution as the real market.
It looks and moves like the real market, but it contains zero actual market signal.
None.
No real-world economic events, no actual institutional buying or selling pressure. It is a phantom market.
That's a great way to put it. Once the phantom market is generated, you run your highly optimized, machine learning-driven trading algorithm on this fake noise data.
And the results of that test reveal the truth of the algorithm.
They do. If an algorithm is genuinely capturing market inefficiencies, like exploiting the speed at which the market prices and earnings reports, it should fail miserably on the fake data because those inefficiencies don't exist in the noise.
Right.
But if the algorithm still produces a high Sharpe ratio, meaning it is showing fantastic returns relative to the volatility it's taking on, even when trading on completely fake data, you have a massive problem.
Because it means your algorithm is completely curve-fitted. It is essentially finding shapes in the clouds.
Exactly.
It is a noise trading algorithm that thrives on randomness, which makes it entirely useless for trading real capital.
A robust strategy must significantly outperform the surrogate data distribution.
Yeah.
If it cannot prove that its returns are generated by real market structure rather than statistical noise, the Monte Carlo results are irrelevant. The truth serum test strips away the illusion of complexity and forces the algorithm to prove its validity.
This entire deep dive has been a systematic dismantling of illusions.
It really has.
We started by exploring the visceral danger of sequence risk, realizing that trusting a single historical backtest is a psychological trap, a sample size of 1.
Yep.
And then we moved through the vast, mind-bending combinatorics of N to the power of N resampling, visualizing billions of possible futures through the cone of uncertainty.
Right, and we examined the mechanical flaws of the simulations themselves, understanding how simple random resampling destroys the critical market memory of trend-following strategies, requiring the use of block bootstrapping.
And finally, we saw how institutional quants use parameter jitter, portfolio risk normalization, and surrogate data to build a mathematical shield, allocating capital based on the 95th percentile of worst-case scenarios.
And the foundational takeaway for anyone interacting with algorithmic systems is this. Monte Carlo simulation is not a crystal ball.
No.
It does not predict the future. Its singular purpose is to mathematically quantify uncertainty. It forces a trader to look into the darkest edges of the cone, allowing them to size their positions appropriately, manage their psychological capital, and survive the inevitable tail risk events the market will generate.
It all comes down to surviving sequence risk. You know, in the incredibly rigid world of quantitative finance, Monte Carlo proves that sequence dictates survival. But the underlying philosophy forces you to look beyond the trading screen and think about your own life, your career trajectory, or your personal investments.
Oh, for sure.
How much of our own personal success or our failures is just a lucky or deeply unlucky sequence of returns? We often look back at the arc of our lives or our careers like a single perfectly optimized backtest.
We really do.
We assume we are absolute geniuses for the choices we made, and we view the path that led us here as inevitable. But if you could run a Monte Carlo simulation on your own life choices, if you could mathematically shuffle the order of the lucky breaks, the macroeconomic crashes, the random job offers, sudden illnesses, would your current life plan survive the 95th percentile drawdown?
That's a heavy thought.
Have you actually stress tested your assumptions about your own resilience, or are you just blindly relying on a sample size of 1? Something to think about. Thank you for joining us on this deep dive. Until next time.